Hello and welcome to 5-Year Club video number 314. Tonight we have kind of a really financial nerdy topic, a really esoteric topic. Not that the others haven't been financially nerdy. It's just that this one is nerdy even for me. But I've been seeing some interesting kind of chatter about it, some articles about it recently, and so I thought that it would be a good thing to cover. All right. We're going to talk about the inverted yield curve. What is an inverted yield curve? Inverted yield curve. An inverted yield curve is an interest rate environment. Okay, so that's talking about the Fed interest rate. All right, that's the base interest rate that sets the interest rates for mortgages and perhaps credit cards and business loans and all credit, right? So if you pump that interest rate up, then credit becomes less available. If you decrease that interest rate, then credit becomes more available because the interest that someone has to pay when they take out a loan is lower, so they're more willing to take out the loan. Okay. An inverted yield curve is an interest rate environment in which long-term debt instruments, okay, so that's long-term loans, that's what they mean, so a 10-year loan, have a lower yield than short-term debt instruments of the same credit quality. All right, so same credit quality means same risk of default. This type of yield curve is the rarest of the three main curve types and is considered to be a predictor of economic recession. Okay, so let's focus on these words a little bit. What is the yield in general? Well, the yield in general is how much money are you going to make on this treasury note, on this debt note. Right? So the United States government wants to borrow money, and you're willing to loan them some, but only if they pay you a yield, right? So if you give them $100, you're going to want a yield of, I don't know, $3 a year from that, or whatever it is. I don't know. You can't ask for too much because they're not willing to pay that much because they're so reliable in paying people back that other people are cool lending them money, so you're competing with those other people. All right, so this graph right here, the yield and the maturity, right? So what this is showing is I guess this is the inverted yield curve, because this is showing notes with low maturity, so that's maybe a short-term loan that you're giving the government, have a high yield, so you loan money to the government for only a year, and they will pay you more money than if you loan the government money and ask to be paid back in 10 years. That's unusual, right? Because if you said, don't worry about it for another 10 years, you would expect them to come up with a way to pay you back more money, not less. You know, if you loan the government money and you're going to require them to pay you back in 1 year. Those are stricter terms. You're not going to be able to ask for as much. So how does this make sense? How can it occur that actually this short-term loan where you get paid back faster also yields you more interest? Breaking down inverted yield curve. A partial inversion occurs when only some of the short-term treasuries, 5 or 10 years, have higher yields than 30-year treasuries. An inverted yield curve is sometimes referred to as a negative yield curve. Historically, inversions of the yield curve have preceded many of the U.S. recessions. Due to this historical correlation, the yield curve is often seen as an accurate forecast of the turning points of the business cycle. A recent example is when the U.S. Treasury yield curve inverted in 2000, just before the U.S. equity market collapsed. An inverse yield curve predicts lower interest rates in the future as long-term bonds are being demanded, sending the yields down. I'm going to read that sentence again. An inverse yield curve predicts lower interest rates in the future. So they are predicting that the Fed is going to lower the interest rate. Why would the Fed lower the interest rate? The Fed would lower the interest rate because they want more credit to become available, because people are suffering and they need to take out loans. And they want to make that money available for businesses to keep paying people, to reorganize, to make moves to get out of the recession. If a recession happens and you don't lower interest rates and credit is very difficult to get, more businesses are just going to shut down and fail. Okay, more businesses are not going to have the flexibility they need to make it past the down market, and that's going to be bad. All right, so what's happening is that if an investor believes this is going to happen, if he believes that in the future interest rates will be lower, then he believes that the future is a worse time to buy a 10-year or a 30-year Treasury note. Because in 10 years or 5 years or whatever it is, he believes that the interest rates the government pays will be lower. So he decides, I'm going to get me some of those higher interest rates now. I'm going to go ahead and buy that 10 or 30-year Treasury note now so that I get the higher rate. But that investor is not the only one thinking this, right? And so as a result, someone else thinks this too, and people start bidding up the prices of these 10-year and 30-year notes. And when the price of the note increases, when the amount you have to pay for the note increases, right, then proportionally that money you're being paid back is lower. All right, so if the government says we're going to pay, $10 a year for one of these things, and it starts out at, it's a good $300, right? So you're looking at a return of 10 divided by $300 a year. But then somebody says, I'll pay $315 for that, because I don't think you're going to pay $10 next year. I think you're going to pay $5. So I'll pay $315. That'll be good. Well, now the return for him is not 10 divided by 300. It's 10 divided by 315, and that's a lower number. But it's worth it to him. But it does mean that the yield of the 10-year note is lower. All right, yield and maturity. Yields are normally higher on fixed income securities with longer maturity dates. Higher yields on longer-term securities are a result of maturity risk premium because changes in the value of long-term securities are more unpredictable, with the market interest rates potentially more unsettled over a longer time horizon. However, yields on longer-term securities could be trending down sometimes when market interest rates are set to get lower for a foreseeable future to accommodate ongoing weak economic activity. Irrespective of their investment rate risk, shorter-term securities appear to offer higher returns than longer-term securities during such times. Yield and the economy. The shape of the yield curve changes in accordance with the state of the economy. The normal or up-sloped yield curve may persist when the economy is growing, and conversely, the inverted or downsloped yield curve is likely to press on when the economy is in a recession. One underlying reason such a relationship exists between the yield curve and economic performance relates to how a higher or lower level of long-term capital investments may help stimulate or rein in the economy. By issuing longer-term securities with lower yield offerings, businesses and governments alike can acquire needed investment capital at affordable costs to jumpstart a weak economy. Yield and bond demand. What moves yields in the market is the varying demand for securities of different maturities at a particular time and under given economic conditions. So like I said, it's, what moves yields is a varying demand. When you have an increased demand for security, when more people are bidding on it, then the price of that security goes up, yield goes down. When the economy is heading to a recession, knowing interest rates are to trend lower, investors are more willing to invest in longer-term securities immediately to lock in current higher yields. This in turn increases the demand for longer-term securities, boosting their prices and further lowering their yields. Meanwhile, few investors want to invest in shorter-term securities when presented with lower investment rates. With lower demand for shorter-term securities, their yields actually go up, giving rise to an inverted yield curve when yields on longer-term securities have come down at the same time, right? So, look at this. Okay, so shorter-term yields go up, then why wouldn't you buy the shorter-term yields? The shorter-term securities have their yields go up, so why wouldn't you buy them? Well, for many investors, right, their investment goals are over a longer period of time. And so if they buy one of these shorter-term securities at whatever interest rate it's at, then a year later, 2 years later, 3 years later, whatever it is, the government's going to hand back their money and they're going to say, good luck investing in the next thing. Good luck, because, I'm giving you back this cash when we're in a recession and interest rates are lower, so you don't have any good options anymore, except you kind of do, because if you're in a recession, the stock market's probably a pretty good buy. But it's a volatile buy. And for many people, what the role that this investment is playing in their portfolio is not a, aggressive stock increase play. It's money that needs to be more stable, so they want it to be in bonds, and they're trying to decide which bonds should they choose. Do you want 3% for 10 years, or do you want 5% this year and 1% all the other? Something like that. Anyway, so the reason, I saw a graph in an article that kind of opened my eyes to this, so I decided to cover this. I hope what I said just made sense. I know that I'm yawning here. It's 9:28. This isn't the most interesting thing in the world. However, here we have a graph, okay? And what this graph represents is the difference in yield between a 10-year treasury and a 2-year treasury, right? And what we are seeing is that it's getting pretty close to zero, y'all. Right? We're seeing that you are not getting paid a premium for investing in that 10-year. Because people think that interest rates are going to drop again. And, if interest rates drop again, then, if they bought that 2-year, then they're going to be screwed. So instead they're buying these 10 years, and that is driving the 10-year yield down. And this is comparing it to the 2-year, and we see that they are about to be the same. And as we just read in that article, there is a correlation between this happening and a recession coming. There's a correlation between this happening and a recession coming. We're now finishing up a 9 or 10 year, well, I don't say finishing, but we are 9 or 10 years into a bull market, okay? And bull markets usually don't last 9 or 10 years. I don't know if I need to say anything else. There's some other numbers I could point out, like personal savings rate, rates of corporate debt, the recently volatile stock market, things like that. But, I'm not a genius Nobel Prize winning macroeconomist. I'm just some dude learning about this stuff in his 30s, even though it's kind of boring. And, part of this is I want to show you stuff, even really nerdy stuff, that makes you think, wow, there really is an economic cycle. There really is a recession coming. I should probably save some money in preparation for that recession. I should probably put some money away so that I have better options when the stock market tanks again and I can buy some of those discounted stocks. I want some money so that when the business I'm working for closes, I have 6 months to search for an actually good job and not 1 month to scramble for anything that will hire me at all, no matter what. You know, the good times are not going to last forever. In October, we got a little tasty taste of, losing 8% of the S&P 500. So, or maybe it's just 8% total right now. I don't know. Point is, this is another signal. It's worth paying attention to. Let's look at, what does it look like if I do a 10-year on this? Okay. So, interesting. So it's been trending down since 2013. And if I look at the maximum value, here we see a recession from the 2000 tech crash, and we see that before that recession happened, this yield curve went down and dropped below zero. Here we see the housing recession, and before the housing recession, this yield curve dropped and went down to zero. Here we've got a recession in the beginning of the 1990s, and the yield curve dropped below that, right before that recession. So, yeah, you know what? It looks like before the recession happens, the yield curve can actually be kind of zero or negative for a year or so. Now, it's worth pointing out that a recession and a stock market fall are not the same thing, right? So it'd be interesting to see kind of when does the stock market tank? Is the stock market tanking on the way up from this increase, or is the stock market tanking somewhere down here? I don't quite remember. I know February 2009 was the bottom of this market. So yeah, at the bottom of the market, it had gone up. So what is this? This is March 2001. Yeah, so anyway, you can look that stuff up yourself. I wouldn't expect another 10 years of results similar to the previous 10 years. I think that's a pretty safe bet. All right, well, that is it for video number 314. I hope that you enjoyed this explanation. Hope you were able to stay awake through it. Have a fabulous evening.